Hello and welcome everyone to our latest webinar. My name is Sid Rajeev. I'm the head of research at Fundamental Research Corp. Our guest today is Anna Solnickova of First Circle Mortgage Investment Corporation. With approximately $180 million in assets under management, First Circle offers mortgages on single-family residential units in BC. The MIC yielded 9.6% in the most recent quarter, which we note is on the higher end of mix offering first mortgages on already built residential properties. First Circle is a brand new addition to our list of top picks. So the agenda for today is I'll kick off the call with our thoughts on mix in general and how we analyze the sector. Anna will join us from after that and introduce us to her MIC, its investment mandate, and more importantly, how her MIC has been able to generate higher than average sector yields for investors. Listeners, you can either wait till the end to ask questions, or if you have questions during the presentation, you can submit your questions and we'll respond to them at the end. Here are some key disclaimers. Please take a moment. All right, so let's get started. In case some of you are not familiar with MICs in general, let's take a look at what a MIC actually does. A MIC typically provides short-term loans, typically 1 year, secured by real estate in Canada. They are required to invest at least 50% of their assets in residential mortgages in cash. Now, unlike banks and traditional lenders, MICs are more flexible in their lending guidelines and offer individually structured and tailor-made loans to meet the requirements of a borrower. Now, lending rates of MICs tend to be in the 6 to 13% range, and they yield anywhere between 6 and 10%, which is significantly higher than that of traditional lenders and banks. Now, we've been covering the sector, the MIC and alternative lending sector for over 15 years now. And our research indicates that there are approximately 200 MICs in the country, managing about $15 billion in mortgages. That means the sector accounts for less than 1% of the overall $2 trillion residential mortgage market in Canada. Now, here are some of the key metrics that we use to analyze a MIC. Number one metric is the assets under management. There are approximately 225 MICs in the country with assets under management of over $100 million. And First Circle is in this list. For comparison, the largest MIC, Timber Creek Financial, manages about $1.3 billion in mortgages. The second metric we look for is the property type, now which ranges from single and multifamily units to construction development projects. Now, we believe already built single family units have the lowest risk among all property types, and First Circle is in this category. Number three is priority or exposure to first mortgages. Higher the exposure to first mortgage implies lower the risk in general. In the case of First Circle, first mortgages account for over 95% of its portfolio. Then we look at the average mortgage size, loan to value, default rates, foreclosure rates, and yields to evaluate a mixed return to risk profile. Finally, let's take a look at the current environment for mortgage lenders. Number one, residential real estate prices in BC are down 12% year over year, but up 2% month over month. Consensus estimates indicate that prices could fall another 5% this year before climbing up. Now, First Circle has a relatively low loan to value, just 52%, which we believe puts them in a very comfortable position. Now, second point is that inflation has started to taper. The Bank of Canada decided to hold its benchmark rate in the past two meetings. That said, as rates are likely to remain relatively high this year, we're expecting default rates and foreclosure to increase. We are modeling significant increase, year-over-year increase in default rates and for loan loss allowances for all the lenders under that we cover. The third point is that as rates are likely to remain relatively high this year, we believe lenders, alternative lenders such as MICs, should experience relatively strong growth as they will continue attracting borrowers unable to qualify with traditional lenders. We're also expecting lower repayments due to this reason. Bottom line, we believe MICs should be able to continue to expand their loan portfolios this year. And with that, I would like to welcome Anna of First Circle. Anna, you'll be able to share your screen in a second. Please go ahead when you're ready.
Wonderful. Thank you so much, Sid, for having me today. It's a real pleasure to be here and to speak to all of our participants. I will just share my screen here. Wonderful. Can you see that okay?
Yes, perfect.
Wonderful. Okay, great. So as Sid mentioned, my name is Anna. I'm the VP Finance at First Circle Financial. First Circle Financial was established in 1991 by our president, Alan Cross. We've always been based on the North Shore of British Columbia, and we have over 30 years of a professional background in managing MICs. That has always been our mandate since 1991. As of today, we're a team of 14, including our president, Alan, who's very much still involved in the day-to-day operations and sets the tone for what we do here from lending, underwriting, management, and operations point of view. We have 3 VPs, myself being one of them, and my 2 other colleagues who look after lending. And we have 4 mortgage underwriters in total, and the rest of our staff look after investors and mortgage administration. So we have a proven track record of delivering steady and stable returns. Since 1991, we have always distributed a quarterly dividend, so that's over 120 distributions on a consistent basis. And we're also an administrator of registered plans, such as RSPs, RIFs, and TFSAs. In 2005, First Circle Financial decided to resign as the manager of our previous MIC and venture out and establish its own MIC. And that is how First Circle Mortgage Investment Corporation was born. So over the last 20 or so years, we have been defined as a MIC under the Canadian Income Tax Act. We offer our investors a diversified mortgage portfolio. We're a tax flow-through vehicle by the virtue of what a MIC does. So by distributing all of the retained earnings of the MIC, we, the company, do not have any taxes, and therefore more of the revenue ends up in the hands of the shareholders. The MIC preferred shares that we're offering for subscription are RSP, RIF, TFSA eligible, so a lot of our investors do hold it through those vehicles. And we also have audited financial statements. So every year, come September 30, our fiscal year end, we have M&P LLP, our independent auditors, come and audit all aspects of the operations. So everything from the way we underwrite, the stipulations we have in our offering memorandum, and the yields that we're saying we're delivering, they verify and vouch independently that all of that is correct and run ethically and properly. And lastly, we have just recently made the move to monthly dividends with quarterly top-ups. This is something that was requested by several of our investors. So far, we've always done quarterly dividends. We thought moving to a monthly dividend with an actual quarterly top-up would be better customer service to our investors and would provide them with a more steady and stable cash flow. So that change is actually coming into effect as of May the 10th. We take great pride in running our books very carefully. Alan and myself are CPAs, so the company is run by accountants, and we like everything done properly and accounted for to the penny. So every quarter, we prepare a full set of books, and we distribute the full retained earnings on a quarterly basis, whereas a lot of our competitors, as far as I understand, only do that on an annual basis. So what is the lending strategy of First Circle MIC? So its mandate really is to lend on first residential, good quality properties in British Columbia. We have always lent in BC since 1991. We know the market very well. And although it may be argued that maybe that does away with diversification, we actually disagree. We would rather be in a market that we know very well, and we have independent appraisers appraise every single loan that we underwrite. And it is a market we're very comfortable with, and we know all of the risk factors. We're not comfortable in Alberta, and we're not comfortable in Ontario. We don't know those segments, and that's why we don't lend there. So as of March 31st, 2023, which is the Q2 of our fiscal 23 or Q1 of calendar 23, 82% of the book is comprised of residential loans. 82% is also conventional, and 96% of the book is in first mortgages, as Sid mentioned. So we consider this a very low risk fund, also combined with the fact that the loan to value ratio is at 52%, leaving a lot of equity in the book were there to be a correction in the market. Over 98% of our loans are 1-year open term loans. And as I mentioned, we only lend in major population centers of Southwestern British Columbia. So that means they have to be, the properties we'll lend on have to be in areas that are highly sought after and desirable. And as any other MIC out there, we always want to know what is the exit strategy, what is the story when we're lending on that property. And as Sid mentioned, we do some construction, but the residential already built out homes comprise more than 75% of the portfolio. We also take great pride in having a lot of independent oversight on us. So we're one of the few MICs that has an independent board of directors and loan committee. Our board is comprised of 5 individuals. One of them is president of First Circle Financial, so he's not independent, but the other 4 gentlemen are. So on a quarterly basis, management will present to the board all of the results, and it's up to the board, obviously, to scrutinize and validate that all of that is correct. The board of directors are also our loan committee. So we have 4 independent loan committee members who review every single loan that we underwrite, and the approval must be unanimous. So if we do a loan and even one member does not like it, that loan does not get approved and does not get funded. And again, these are independent entities from the people doing the underwriting. We also have the independent auditor that scrutinizes our operations on an annual basis, I mentioned. We're one of the few MICs in town that decided not to bring the EMD services in-house. We have an independent exempt market dealer partner, and they also review our OM and operations to make sure that we're delivering what we say we're delivering. We, of course, work with FRC to have independent analysis reports. And our Bank of Montreal that we recently engaged with, they of course expect us to uphold a certain level of operations and ethics and governance. We report to them on a monthly basis on the operations, as well as on quarterly and annual basis with respect to the financial covenants. And lastly, we have a lot of regulators involved in our space. We have the BCFSA, which regulates the mortgage brokers and our lending operations and our underwriting operations. And then we have the BCSC that regulates us on the capital raising side, and they are really the watchdog from the capital investor point of view. So as of March 31st, 2023, these were the quarterly results for First Circle MIC. As Sid touched on, for this past quarter, as well as the December quarter, we're very proud to announce that we have a yield of 9.6%. As far as we're aware, it is one of the higher yielding funds out there. We do have an AUM of just shy of 180 million across 241 files. So that's roughly 740,000 in the mortgage size. Our capital outstanding is 134 million, and we do have the ability to borrow up to 85 million with the Bank of Montreal. We're into that line comfortably at roughly 50%, so 43 million. Our default rate is 2.6, and that is below industry average as far as I understand. It's something that we also take great pride in because we are so well run, and everything that we do here is from an accounting point of view and a great level of governance. We take great pride in underwriting loans carefully, but of course, focusing on the yield. And this chart here represents the returns that First Circle Financial, as the manager, has been able to obtain and deliver to its investors since 1991. So the first year of operations being 1992. So if a client took $10,000 and invested it with First Circle Financial in 1991, that accumulated growth would be, in today's day and age, well, I should say as of September 30th, our most recent fiscal year end, will be just shy of 170,000. Whereas if that person was to take that $10,000 and invest it in the stock market, you can see the volatility of that. So we really take great pride in being a steady, stable return for our investors. We're all about partnerships, relationships, long-term returns, and providing great value to our investors, knowing it is backed by real estate in British Columbia, and it is a well-managed 30+ years experienced management team and an independent board behind everything that we do here.
Thank you, Anna. That was very useful. I should give a disclaimer for the last slide, which Anna showed, which is past performance is not indicative of future performance. So everyone keep that in mind. But again, thank you so much, Anna. We can open the call to a Q&A. Listeners, if you have any questions, please feel free to type them in, or you can click on the raise hand option and I can unmute you. But while I compile these questions, Anna, I have a bunch of questions. Maybe we can start with that.
Certainly.
Do you mind giving us an idea, what type of investors do you attract? Or maybe you can talk about your current investor base. Is it mostly retail, institutional? And how do they come to you?
So far, we have really grown to the size that we're 134 million organically through word of mouth, and a lot of it is the family, friends, or acquaintances of our board and management. The board and management and their families hold 25% of the capital in First Circle MIC. Lately, we are wanting to grow the MIC and are hoping to attract more institutional level investors. We are open to all levels of investor and happy to work with anyone and everyone that is interested in investing in First Circle MIC.
That's a very important point in our analysis for the audience here. If you have seen our reports in the past, skin in the game, management skin in the game is something we look at. And this 25%, which Anna mentioned, is very high because most mix management owns mostly 2 to 5%. So skin in the game is very important. So thank you for that, Anna. Maybe let me just jump right into the biggest question, most important question is, you run a relatively low risk portfolio in our mind due to your focus on first mortgage, due to your focus on already built residential properties, which we feel is one of the lowest risk segments across all property types. How do you manage to generate higher than average yields? Maybe some points there.
Yeah, absolutely. That's a great question. I think ultimately it really comes down to our president's experience. So having gone through various economic cycles and being in this industry for 30 plus years, he sets the tone for everything that we do here. And so the reason why we're yielding 9.7 today is because 18 months ago, he had the foresight to say to our lending department, you need to start doing all of our loans, especially residential, on variable rate mortgages. And so as of today, 83% of our portfolio is on those floating rates. And in a downward trend, our investors are protected because we have that floor rate built into all of those rates. So that's one way how we've been able to outpace our competitors with yield. The second approach we use is construction. So a small portion of our book, 13%, is construction, and it is always residential. Most of the time, it's either spec builds or somebody building their dream home that they plan to then occupy. So that's 13% of our portfolio. And what we do there is we charge the client a standby fee, just like the bank would charge us a standby fee for unused portion of the funds that we've been promised. So that further boosts the yield to our shareholders. And thirdly, we use our line of credit with the Bank of Montreal to boost yield via leverage. So the rate that we pay to the bank versus us take those funds and lending them to our borrowers, the spread there can be anywhere between 3 and 4%. And that again further boosts our investor yield. So that's our three-pronged approach. But really, for the most part, I feel strongly that it is the variable rate mortgages that account for such a large portion of our book that have been enabling us to deliver that high yield.
Now, do you mind walking us through your typical lending process? How do you source mortgages? And when you get them, what do you do? How do you analyze? How long do you take? Are you faster than the banks? It's just give us a cycle of a typical loan.
Yeah, absolutely. So 99% of our loans come from BCFSA licensed mortgage brokers. So we do not market or deal with the consumer directly. The remaining 1% would be repeat customers, most of the time professional builders that come back to us and want to bypass the broker. So we have a vast network of brokers that we've established relationships with and that know our product well and that we trust to have already done their due diligence, and they know what we specialize in, what we expect, and the level of ethics and governance that we would want to see through that application. So when the application comes through, one of our 4 underwriters will look at it. They will more than likely call the broker and ask, what's the story? Why does the client want or need this money? Why are they coming to us and not somebody else? And what is the exit strategy? Most of our loans are 1 year open, as I mentioned. So we always want to know, once that 1 year term is over, what is the client's exit strategy? If the loan is something that fits within our parameters, we'll price it, we'll quote it, we'll correspond with the mortgage broker, assuming that the conditions and pricing are acceptable to the client. The loan will be then sent to our loan committee for approval. Those are the 4 independent board of directors that I mentioned. And given that that is approved, we then fund it through our lawyers. And then from that process on, basically the loan is instructed, funded, and dealt. Our lawyers and the client's independent lawyer will then coordinate with one another. And after that, the client is making their monthly payments on pre-authorized debit, assuming everything's going well and they wish to renew with us. We may or may not extend terms of renewal after that 1 year, depending on their payment history and other factors.
Okay, got it. Now, most MIGs are asset-based lenders, or at least all MIGs are asset-based lenders. Their main concern is the quality of the collateral. How much weight do you put on credit risks? Do you look at credit scores of borrowers? Who is a typical borrower?
We do look at the credit bureau and their credit score, but it is not as important as it is to the banks. And it is not as important for our underwriting. For our underwriting, like you said, we're equity based. So we really care about the quality of the home, and say that the borrower is not financially strong. We would actually build in an interest reserve, or perhaps have an inter alia over various properties, or have a guarantor come on title. So we're not so concerned with the financial ratios from that point of view. We're very concerned with the quality of the property. Like you said, the security is first and foremost important to us. And then also, as I mentioned, the exit strategy. Because we're meant to be a short-term solution. We're meant to be credit rehab or finish your home or whatever the scenario is that you're facing right now. A year from now, we want you to be in a position where you can go to a conventional bank and pay a lot less. And for us, the benefit of that is we then get to turn around and lend that money to somebody else, and our investors are better off for it.
Okay. One of the things, common questions we get as analysts is some investors tend to misrepresent the sector by calling it subprime lending. And my goal is to kind of educate them on, hey, it's not subprime lending. It's again, everything depends on the value of the collateral. But who is a typical lender, the profile? Are they new immigrants, entrepreneurs? Are they subprime,
Yeah, so the typical borrower would be anyone that is not able to qualify with the bank. Now, that doesn't necessarily mean that they're a bad person or have bad credit. It just means that the bank's criteria for lending, because of OSFI and all the other regulations that they're beholden to, is very cookie cutter. They have very tight boxes that they have to fit this borrower within. We don't have that. So even though we're heavily regulated, we're not cookie cutter lenders. We're very flexible. And you asked me earlier how long it takes us. We pride ourselves on being very quick turnaround. So from the time we get the deal to having a quote to having the whole thing approved, we really try to do that in 2 to 3 business days. It can be as quick as that, sometimes even quicker. So the average borrower for us is somebody that, like you said, is maybe new to the country, doesn't have established credit, and that's why the bank would deny them. Maybe they do want to do construction, which the bank doesn't like. Maybe they're business for self, which the bank doesn't like. These are all very qualifiable individuals. They just don't fit that cookie cutter formula for the banks. So that's why they come to us. And they're definitely not subprime. They are good quality borrowers with excellent properties. Otherwise, we wouldn't lend on them. And they're just trying to get into properties that otherwise they wouldn't be able to finance. And as you mentioned, our industry has this subprime stigma around it. And I think that's very unfortunate, because there's also alternative lenders is how we like to position ourselves. That's what it is. We're an alternative to the banks. And we provide a very niche service to both borrowers and investors. And as you mentioned during your overview, we represent a fairly large part of the construction and financing and mortgage sector within Canada. And there definitely needs to be a bit more brand rehab, I think, in that regard.
Okay, so we talked about the collateral, the quality of the collateral. Obviously, the fluctuations, real estate prices do impact the sector, do impact the originations. Last year, we saw a significant decline in sales, originations, prices declined as well, 15-20%. How has that changed your investment mandate? Have originations declined for you? Do you mind giving us more color on the current landscape?
Yeah, certainly. Yeah, I mean, I think you can be living in BC or in Canada or anywhere in the world without being aware of what's happening with the real estate segment. Definitely there are changes coming, and because of the Bank of Canada rate increases, that has already been felt through sales activities and valuations. So again, because of having gone through a few of these market cycles already, 3-4 months ago, we already started adjusting our pricing and our lending appetite for a variety of properties. So we've always shied away from the ultra high-end homes, because we want to be lending on properties that are always desirable. So the single family dwelling on a cul-de-sac in a very popular city where kids are playing hockey on the street, that is our bread and butter, and that's what we like to lend on. So one of the ways we've adjusted our lending is we're just being even more picky than we were before. So ultra conservative. As you have mentioned, our loan to value ratio is very low. It has actually been decreasing over the last several quarters because we are being more protective of how much money we will lend out. And we are now starting to actually lend at fixed rates because now there is that negative stigma associated with variable rate mortgages. So our investors are protected because of those floor rates. We do not foresee the Bank of Canada increasing rates any further. So from that risk point of view, we thought we can actually attract more originations by switching to a fixed rate and being even more careful with the type of loans we will take on.
So last year, a lot of MICs or most MICs saw a significant increase in loan requests because they were rejected by the traditional banks. What's the scenario now? Are you seeing the same level of incoming questions? Have originations declined or?
Originations have declined. Well, I would put it this way. I would say the number of originations and requests is the same. The quality has eroded. And that's really the biggest difference there. So our underwriters are still very busy analyzing loans, but the conversion rate, the closing rate is down from what it was even 6 months ago.
Is that because you are more conservative or you
Yes.
said borrowers, the quality has declined?
Well, I mean, I think it's a factor of both. We're being more careful, we're being more conservative. And it's not so much that the quality of the borrower decreased, it's that their financial position has worsened because everything costs so much more now. So, they're now actually in a position where they're asking for second mortgages again, whereas second mortgages were incredibly difficult to come by when we were in that 325 prime sort of environment. So the market is definitely turning toward that. Our mandate to our investors is to protect what they're investing with us and have that be backed by good, not too risky loans. So that's what we're focusing on.
Now, in terms of the LTV is 52%, is that something you're going to keep declining or because we see most MICs have reduced the LTV by about 10% since the onset of the pandemic. I think you've done the same. Now, are you happy at where the portfolio is at now or?
Yeah, we're very pleased with the risk profile that we have. The danger with being too conservative and going too low is then you are starting to erode investor yield. So it is a fine balance of having the right blend of risk and reward. We're comfortable and happy with this 52%. Historically, it's been between 50 and 60. So this is definitely more toward the cautious conservative end. And we do expect to continue this type of LTV going forward. I don't think it will dip below 50% because we are also wanting to stay competitive and actually have some originations on our books. So we have to be cognizant of that and strike that right balance of risk and reward.
Okay, I think I have two more questions for you, Anna. Let's talk about the yield for a second. So 9.6%, that was the yield last 2 quarters. Do you give guidance to investors? Do you want to talk about how much you're expecting this year?
Our forecast is, and ideally in a best case scenario, knowing that nobody has a crystal ball for the future, of course, we would like to continue yielding at this rate, 9.6, and we do think it's achievable and attainable. Ideally, we would like to be north of 10%. That, however, I'm not sure is attainable in today's market. So we do expect and hope to be yielding between 9 and 10%. I know FRC thinks that's probably a little too ambitious, but we hope to prove you wrong.
Yeah, so one of the reasons why we're conservative across the board for all lenders is we are assuming some kind of loan loss allowances for all lenders. One of the things that stood out for us for First Circle is that there's zero provisions or zero loan loss allowances, which is very rare in the sector. I don't think I've seen any other MIC with 100 million plus AUM with that kind of confidence in their portfolio. I mean, it's a combination of confidence, management's confidence, and also the auditors allowed them to do so. Now, do you get that question from investors that, hey, you have some impaired loans, but why don't you have any provisions? Is that a problem?
Yes, we do get that question, and quite often, because like you said, we're quite unique in the way that we do that. And as you also mentioned, our auditors are 100% behind management strategy in this, because when we do have loans that are in foreclosure, so for example, as of March 31st, of the 241 loans that we have in the portfolio, 7 of them are in foreclosure. One is actually not in foreclosure, but the client has passed away, so we're just waiting for probate to take place. So 6 are truly in default. Of those 6, not a single one is impaired because, as I mentioned, the loan to value is so low. We have a new appraised value as of very recent, 1 to 2 months ago. So we know what the true value is as of today. And we run a super thorough line by line analysis of what our cost and what our equity at the time of realization. So 6 months or the nice side plus 4 months listing period, what our realization will be at the end of that redemption period. And unless that number is north of 100%, we do not make a loss provision. And not a single one of those loans that I just mentioned, of those 6, are anywhere near that 100%. So that is why, from an accounting as well as operations and management point of view, we do not foresee the need to make losses. And this has been the trend for First Circle MIC since its inception in 2005, and also First Circle Financial since 1991. This is always the way we've gone about analyzing and managing the portfolio. And it's all within the IFRS 9 regulations, and our auditors have given us the blessing to continue this way. So that is how we foresee continuing.
Okay, finally, let's look at the key risks of the sector. What can go wrong? So number one, prices can keep going down, but your LTV can protect you. Right now, you have enough cushion. Second thing is originations can decline significantly, or you could see a huge amount of repayments. What can go wrong? What do you kind of, in the worst case scenario, what's your analysis? What do you look at, and how can you survive that?
Right. So really the LTV is the biggest one. So valuations or interest rate risk as well, right? So if rates continue increasing to a level where clients cannot afford those payments anymore, then you have more of the portfolio in foreclosure, which is what we're facing now. And when you combine that interest rate risk with declining valuations, which is also what's happening now, unless you have a very strong underlying portfolio from 2 years ago, not just a month ago, you're looking at that crunch, and you're looking at those losses. So because our portfolio underneath is very strong and that LTV is only 52%, we're protected, we feel, from both factors, whether it's valuation decrease or interest rates continue to increase. The other risk associated with MICs, and I think this is across the board, is the liquidity, right? So as you mentioned, if, for example, we have a large amount of payouts and not a lot of originations, we could be in a situation where the MIC starts carrying cash on its balance sheet, and that's actually bad because that kills yield. If we have unutilized capital, it is not performing and it is not yielding. So that is something we always want to shy away from. We don't want to have cash on our balance sheet, and we want to be into our line of credit at all times, assuming the capital, of course, is always fully deployed. And the liquidity risk from the client's point of view, from the investor's point of view, is, say you invested $5 million, a month from now you needed that money back. Would we or would we not be able to facilitate that request? So the way First Circle MIC has structured its offering memorandum is we ask that the investor give us written notice that they wish to do a redemption. That goes in front of the board of directors on a quarterly basis. We have never declined a redemption in 20 plus years of operations, but depending on the size and how the liquidity of the MIC is, it may take us a few months to fulfill that redemption. So those are, in my opinion, the 3 biggest risks for an investor entertaining the MIC space.
For redemptions, if you get large redemptions, do you use your line of credit to fund those redemptions, or
yes,
you wait? Yeah, okay.
No, we would. So on a weekly basis, management does a thorough cash analysis, and we have a cash flow meeting. And as far as we're concerned, liquidity is liquidity. So whether it's financed by payouts or our line of credit, as long as we have the capacity and the liquidity to fulfill. So instead of taking on new loans, we would simply redeem out that investor and forfeit any originations until we were once again in a liquid position to do that.
Okay. Who is your lender? Where do you get the line of credit from?
Oh, we're with Bank of Montreal. So this is a fairly new relationship for us as of May 2022. And it's a syndicated line with 2 lenders.
Fantastic. Thank you so much, Anna, for this.
Thank you, Sid.
It was, I'm sure it was useful for all the attendees here. It was very useful for me. I learned some new stuff too. But do you have any closing thoughts, final comments?
No, I just wanted to thank you and FRC for the relationship and for the partnership and for hosting us today. And we're very excited to speak to anyone who's interested in First Circle MIC or just wants to know more about the MIC space or us, First Circle Financial.
Yeah, no, thank you so much. A recording will be uploaded on our YouTube channel shortly. Please ensure you subscribe to our YouTube channel and also sign up to be a member for platform research, frc.com. You'll get alerts when we publish new reports. And of course, you'll be able to see a list of top picks. I mentioned First Circle is also a top pick. And to access First Circle report, go to our homepage, search for First Circle Mortgage Investment Corporation. We initiated coverage on the MIC last year, and we did an update last month where we upgraded the company to our top picks list. But thank you, Anna. Thank you for all the attendees. Have a good day. Thanks for watching this, and wish you all the best and stay safe.